Hi, today we're going to present our case study on investment appraisal focusing on Zen Life Sendirian Berhad. Other than that, in this presentation, we will look at how small and medium enterprises or SMEs make smarter financial decisions based on the article named The Challenges Among Malaysian SMEs. Before we continue with our presentation, this is the group members from AC11058.
They ask you how you are, you just have to say that you're fine when you're not really fine, but you just can't get into it because they would never understand.
Hey, hi, what's the problem?
I don't understand this question. This is September 2021.
Okay, let me see that. I think we have do it before with Madam Chani, right?
Yeah, I think so.
But I don't have a schema, do you?
I think there is a link that is to YouTube. Teach us how to do it right. So can you show me?
Yeah, sure.
Okay, so basically this is the question 4 of September 2021. Without wasting time, let's go to the next slide for the answer.
The initial outlay begins with the total cash outflow for acquiring the new machine, which consists of the purchase price of 110,000 and installation cost of 30,000 and transportation cost of 10,000, giving a total sum up cost of 150,000. This amount is adjusted for changes in working capital, where inventory decreases by 25,000 and account payable decreased by 20,000, resulting in a net cash outflow of 145,000. Cash inflow from the disposal of the old machine is 31,000. The old machine has a net book value of 40,000, calculated from its purchase price of 80,000 plus to accumulated depreciation of 40,000. Since the disposal results in a loss of 9,000, a tax saving of 2,160 is obtained, calculated as 24% of 9,000. Therefore, the total cash inflow from disposal is 33,160. After deducting the total cash inflow of 33,160 from the adjusted cash outflow of 145,000, the net initial outlay is 111,840. The annual cash flow is calculated by identifying the incremental benefits and costs arising from the investment. The benefits consist of an increase in sales of 28,800, which is calculated as 12% of 240,000, and a decrease in operating expense of 8,800. calculated as 10% of 88,000. This results in a total annual benefits of 37,600. From these benefits, the increase in depreciation expense is also deducted. The depreciation of a new machine is 40,000 per year, while the old machine depreciation was 8,000 per year, resulting in an increase in depreciation of 6,000. After deducting this amount, the increase in profit is 31,600. Tax is then applied at 24% on the increased profit of 31,600, giving a tax expense of 7,548. After tax, the net income is 24,060. Since the depreciation is a non-cash expense, the increase in depreciation of 8,000 is added back to the net income. Therefore, the annual cash flow is generated by the project is 30,060.
For this slide, I will explain the terminal cash flow. Terminal cash flow is the cash the company receives at the end of the project, where all operations stop and assets are sold. It also includes the recovery of working capital. First, we look at the salvage value of the equipment. At the end of this project, it can be sold for 80,000 ringgit. Next, we add the decrease in material, which means the remaining inventory is converted into cash. This gives us 25,000 ringgit more. After that, we subtract the decrease in account payable. This is because the company must pay off its outstanding bills, which is 20,000 ringgit. So, the calculation is 80,000 ringgit plus 25,000 ringgit minus 20,000 ringgit. The result is a terminal cash flow of 85,000 ringgit. This amount represents the final cash inflow the company received at the end of the project. Next, I will explain the payback period. Payback period shows how long a project takes to recover its initial investment from the cash inflows it generates every year. The formula is payback period equals initial outlay divided by annual differential cash flow. In our case, the initial outlay is 111,840 ringgit. The annual differential cash flow is 30,060 ringgit. When we divide these two amounts, we get 3.73 years. This means the company needs about 3 years and around 9 months to get back the money it invested at the beginning. The shorter the payback period, the better the project is for the company. Next, I will explain how we calculate the net present value or NPV. First, at year 0, the initial investment is 111,840 ringgit, which is a cash outflow, so it is shown as negative. Next, from year 1 until year 5, the project generates an annual cash inflow of 30,016 ringgit. Since this amount is received every year for 5 years, we use the present value of annuity factor 10%, which is 3.7908. When we multiply this, the present value becomes 113,784 ringgit and 65 cents. Then, at year 5, there is an additional cash inflow of 85,000 ringgit. This amount is discounted using the present value factor at 10%, which is 0.6209, giving a present value of 52,776 ringgit and 50 cents. Finally, after deducting the initial investment, the net present value is 54,721 ringgit and 50 cents, which is positive, so the project is acceptable. For this slide, I will explain the calculation of the internal rate of return or IRR. At the discount rate of 10%, the net present value is positive at 54,721 ringgit and 15 cents. Next, we test a higher discount rate of 24%. Using the present value of annuity factor at 24%, which is 2.7454, the present value of the annual cash inflows becomes 82,405 ringgit and 93 cents. The cash inflow at year 5, which is 85,000 ringgit, is discounted using the present value factor at 24%, which is 0.3411, giving 28,993 ringgit and 50 cents. After deducting the initial investment, the net present value at 24% is negative 440 ringgit and 57 cents. Using interpolation, the internal rate of return is approximately 23.89%. Since the IRR is higher than the cost of capital, the company should replace the old machine.
Next, I'm going to review and summarize the selected SMS issues. First, financial constraints. Financial issues are the most severe and persistent challenge among Malaysian SMEs. Many SMEs struggle with limited access to credit and external financing, lack of capital during startup and growth phases, weak financial planning, poor cash flow management, and inadequate record keeping. Although government assistance exists, SME owners often lack the financial knowledge to manage funds effectively, leading to inefficient use of resources and high failure. Second, management issues. Management capability is another major weakness affecting SME sustainability. Common problems include lack of formal management and leadership skills, inability to prepare proper business plans, poor decision-making and short-term business orientation, limited emphasis on training and human resource development. Many SME owners rely heavily on experience rather than structured management practice, which restricts growth and reduces competitiveness in a dynamic business environment. Third, marketing challenges. Marketing-related issues further hinder SME growth and survival. These include lack of marketing knowledge and branding strategies, weak customer relationship management and low customer loyalty, limited market access, networking and export capability, and ability to maintain product quality, design and competitiveness. Poor marketing skills prevent SMEs from expanding their markets locally and internationally, contributing to low survival and growth rates.
Zest Food is a family-run business producing healthy organic snacks for local stores. Like many SMEs in Malaysia, growth is their dream, but challenges stand in the way. Zest Food needs 200,000 ringgit to expand production, but with messy accounts and no assets for collateral, the bank rejects the loan. The owner turns to high-interest credit cards, shrinking future profits. The owner becomes manager, accountant and marketer. A marketing graduate joins, but leaves after 6 months for better pay in Kuala Lumpur. Zest Food's digital presence is left behind. With new e-invoicing and ESG rules, Zest Food struggles to adapt. Without IT system or consultants, everything remains manual, making the business slower and less attractive to big buyers. Cheap imports and digitally strong competitors take market share. Rising electricity costs and minimum wages tighten the pressure even more. Without support, many SMEs like Zest Food fall into the growth trap, stuck between survival and expansion.
We will talk about the investment appraisal process. The first one is to identify the investment opportunities. According to the articles, many Malaysian SMEs fail because owners invest without fully understanding their business challenge. Therefore, identifying the right investment opportunities, such as improving marketing, upgrading equipment, or even enhancing management skills, is crucial to address these weaknesses. Second is to estimate the costs and benefits. The article highlights that SMEs owners often misuse funds due to the poor financial management. Estimating costs and benefits help SMEs plan their finance better by understanding both financial returns and non-financial benefits like stronger branding and improved competitiveness. The third one is to evaluate the risk. SMEs in Malaysia face high financial and market risk, especially due to the limited access to credit. Evaluating risk allows SME to prepare mentally and financially, which is the article emphasized as necessary for improving SME's survival rates. Lastly, apply the appraisal techniques. By applying investment appraisal techniques, SMEs can avoid making decisions based purely on experience and instead use structured financial analysis, which the article suggests is lacking among many SMEs owners.